Hey everyone, and welcome back to another earnings call coverage with your host Kevin Dubrisky here at Benzinga. Today we're going to be covering Costco. Now, Costco is a huge retailer and really a strong stock, especially for those who are buy and hold. So let's break it down. What's on today's agenda? We're going to be covering previous earnings reports, Costco's performance year to date, and um, so sorry about that. We're going to be covering Costco's performance year to date, Costco's stock analysis, and a little bit more as well. I do apologize about the technical difficulties. So, a quick rundown on what is Costco. Costco operates 871 warehouses globally. They are a membership based retail model, and they have a strong competitor against Walmart and Target. These are very large consumer spending areas that we want to keep an eye on. And it's also a very defensive stock during downturns. So when we see the stocks or the stock market in a whole, like the S&P 500 or the NASDAQ taking a turn to the downside, a lot of times we see Costco hold strong. Guys, let me know in the chat if you are a investor of Costco. So why this earning report matters, consumer spending trends are very important. Costco did already report its earnings, but they didn't have their earnings call just yet. You guys can see the information right below on how they did beat and miss, and I'm going to be covering that in just a moment. Now, we have to recognize that inflation has a huge impact when it comes to retail. It has a huge impact on what we can buy, when we can buy, and how much we can buy. So when it comes to a large trader or a large company like Costco, it really does have an impact, especially when it comes to tariffs as well, which has been in the mix ever since Trump has sort of been elected. So membership revenue is very important. We want to see that there's consistency in membership revenue. Has Costco been able to hold the same amount of members? Has it been able to steadily increase, or have they sort of plateaued? And broader retail sector outlook is very important. We want to know what the retail sector is doing in whole to be able to understand the common trend or theme of these stocks, such as Costco, Target, Walmart. Costco stock performance year to date is over 40% return on investment over the past year. Now that is outperforming the S&P 500 by itself, and it's driven by strong sales and membership growth. So we know that Costco has been a very consistent stock. Membership fees are very important. This is how Costco makes a good portion of their money. So membership fees will likely be a key topic in the results and commentary. So when the call starts at 5 p.m. Eastern, make sure to keep an ear out for what they're saying about the membership fees. Are they increasing the cost, or are they decreasing or keeping it the same? Now, Costco did announce a long-awaited membership fee increase, which is effective this September. So where do we see Costco going from here? Is increasing the membership fees going to cause a stronger issue on Costco and people are going to then get rid of their memberships? Or are they going to be able to increase their fees while remaining consistent with their members? This will be the second quarter reflecting the impact of these increases. So we have to make sure that we're listening in on what they have to say. This call is super important for the longevity of Costco going forward. So the last earnings recap, that's Q1 for the fiscal year 2025, the expected was $4.04 earnings per share versus the year over year 3.58. Revenue was 60 billion, almost 61 billion, and it was same store sales was up 5%. So Costco was very consistent. It showed good growth on the last earnings recap. Now, the current earnings expectation, so this is the revenue we had, and we have a beat on the earnings per share. So we have, let's see, do apologize about this. EPS is expected at 4.13, while same store sales is up 6.6%. So that's even higher than the previous, which was 5%. So it looks like Costco is moving stronger. Now, the options implied move is about a 3% move, and that's just sort of how it's gauged within the options market. Now, this earnings report, the EPS's earnings per share is 4.02 versus the 3.71 year over year. The estimate we missed of 4.10. So we missed by 1.95%. This is a miss on Costco's earnings per share, guys. Revenue is 63.72 billion versus the 58 billion year over year. This is up 9%. That's something I like to see. That's positive on Costco as a company. And the estimate was a beat. We were able to beat revenue by 0.93%, almost 1%. This is great. That is good. But we really want to see that EPS move higher as well. So some key takeaways from the last earnings call: membership grew 7.2% to 139 million members. The margins were stable despite inflation, and the e-commerce sales also had some good growth to it. Positive guidance from management was a key when it came to the growth of Costco. So some key factors to watch would be the membership retention after the fee increase. Now, the fees will increase, like we said, in September. So we're going to keep an eye on this earnings call as well as the next two earnings calls as well, just to make sure Costco is moving higher consistently and revenue is also consistent. We want to see consistency when it comes to stocks that we are owning over time. That way we know that the growth is true. Consumer shift to at-home dining. So this is a bit of a red flag and green flag all at the same time. Now, if we have more people dining at home, well, that means they're not going to be going out to a dining area. They're going to be buying more at Costco so they could cook at home. So this is a great impact for Costco. Inflation impacts on margins. As we know, inflation is going to impact everything, good or bad. Things will get more expensive, but it will also force others to not go out to eat more, which then, of course, brings them back to stores like Costco, Target, and Walmart to find those consumer goods. And the e-commerce and warehouse expansion has been good, so we want to listen out for that as well. This earnings call is super important. It's coming on at 5 p.m. Eastern, and we want to make sure that the e-commerce, the warehouse, and the memberships are all growing. If we see that it's starting to slack off a little bit in one of these areas, then we want to sort of keep our ears up. We want to be able to be aware of this and be ready. So market positioning and options flow. It does have a bit more of a bullish option sentiment, and it does have very low short interest, which is phenomenal for a long-term buy and hold. Institutional holdings do remain strong, which is a fantastic thing as well. So some possible market reactions post earnings, and we're going to go over the stock chart itself in just a moment to find some key levels and areas that we might be able to buy or even sell at. So if we're bullish, we might look for strong revenue and stable margins. Bearish, we're going to look for weak guidance, maybe slowing growth. Or neutral, where earnings meet expectations. So far, what we got so far on the earnings report was we had one beat and one miss. So right now it's sort of in the air, and it's very important to listen in on the earnings call to understand more in depth of what's going on behind the scenes of Costco. So now that we're done with the slides, we're going to break it down into the actual chart. So we'll break it to the 5-minute first. And the first thing I do notice, so we'll put our extended trading hours on, is the initial reaction. Now, it was a bearish reaction, but it wasn't the strongest. It brought us from about 1027 to about 1004, which is only about a 2% move. However, it has already started to pull back, only down about $10 pre-market. This is not that drastic of a move. We see even the previous day had a $14 gap down, and there were no earnings involved to push that gap. So me personally, I don't think we're going to see that strong of a move because of these earnings, but it can lead to some higher time frame consistency. Now, I want to break it to the weekly time frame. We always want to start on a higher time frame when we're looking to buy and hold. Now, what we see consistent higher highs and higher lows. So this tells me this is in a bull trend. So that means even if the stock wants to move down, let's say we move down here and hold, well, then we're still in a bull trend because we're holding this recent higher low. And we're going to mark that out for you guys as well. We have a higher low here, some higher lows here, and some higher lows here. So if we're able to hold these, we could see that we're in a bull trend and we should be looking for continuation. Now, if we do manage to break this 902, which is right near a key psychological level, 900, this might be either a great place for a buying opportunity if we're able to break it and continue back higher, or if we do want to push lower, depending on how the current economy is looking, we might be able to push lower to that next pivot, which is around 793 at that 800 level. That's another $100 move off of Costco if we're able to break 900 and see some sort of close below. So there's a few things that I am looking for on Costco. Guys, let me know in the comments in the chat if you do invest in Costco and how long have you had it and what price did you buy it at? Now, if we're looking at this weekly time frame, we do see that even from 2023, and we'll mark that out, we've had 116% ROI, return on investment on Costco. That's huge, especially for a stock in a company that's been around for so long. We see even back in December of 2018, the stock was trading at just $200. So that makes me think, perhaps are we a little inflated on price? Do we need to come back and lower? Well, we could throw our indicators on our chart and we could look at the RSI, which is our relative strength index, to see are we above our 70 level or below the 30 level. Now we see every time it was trying to push above this 70 level, it stayed bullish for a little while until it was able to rebalance itself, but it remained in that bull trend. So something I would definitely keep an eye on Costco with this RSI is the divergence. So we see that Costco was able to make a higher high, but the RSI did make a higher high as well. So that is important because that tells us this trend might be true and continue. So we made higher highs on the stock, we made higher highs on the RSI, and we also made higher lows on the RSI as well. Now, if we pair the RSI with the MACD, that will also give us a good idea of direction if we can't get the direction off of the stock chart itself. Now, the RSI is showing, the MACD is showing a bullish crossover from February 3rd. Now, today is March 6th, and it's still pushing higher, although it looks like it's trying to break that downtrend. So again, something very important to me, in my opinion, on Costco is how it's going to hold that key psychological 1,000 level. Once I see how we hold 1,000, I'll see if we want to retrace back up to 1,100 or if we want to come back to our key psych level of 900. Let's get rid of these indicators down here so we can get a bit of a clearer view of the chart. Now we're going to break it down to the daily time frame. That was the weekly time frame. So obviously weekly, we're looking very bullish on Costco. Let's break it down to the daily because the daily is going to tell us a much different picture. Now looking at the daily time frame, I see that we're very range bound on Costco. We have highs around 1069 and we have lows around 1020. Again, key psychological level 1000. So we see earnings broke us below this level. But I really wouldn't be so quick to buy puts or short the stock unless I see some good continuation. Because right now, all I see on this daily time frame is a bullish trend and now a channel. Now, when we create channels like this could also be some sort of bull or bear flag. So if we draw our trend lines like this, it's sort of starting to base out as a bull flag. So I'd be careful that we don't break out to the downside first, trying to fake out sellers, get people to sell their position early, and then reverse back higher. And that would look something like this, where we break lower, and then we reverse back higher to all-time highs. Now, Costco was just at all-time highs just this past month, so it wouldn't be that out of the ordinary for it to go make some new all-time highs again. We see for this trend right here, starting on February 3rd, we created an all-time high for 1, 2, 3, 4, 5, 6, 7, 8. 8 trading days, almost 8 days in a row. There was one day in the midst that it didn't make an all-time high, but for 8 trading days in a row in this bull run, Costco was making all-time highs. So because I know this run was so recent, I'm really against trying any short positions or any puts. Now, a lot of people, when they're day trading, instead of buying or selling the stock itself, they're going to sell or buy options. And we could take a look at the options chain as well. Right over here on TradingView. So we can look at the chain and we see options. We have calls. We could put Costco in there. It's cost, C-O-S-T is the ticker for Costco. And we see that they are very expensive, the contracts, right? 32 and 10 cents. That really means it's $3,210 for one contract. So you could also create some sort of spread where you buy and sell one, so they sort of even each other out and you have a defined risk. So you could maybe look for a day trade on Costco. We could even see this is the April 4th expiration. Like I mentioned, today is March 6th. So we could even look for the next week out if we were only looking to sort of swing this for a couple of days. And we could look to see maybe the 1035 strike or something along those lines. It's really going to depend on the market and the momentum. Now, something that's important to me when it comes to trading after earnings is volume, because volume is what moves the market. Now, we see on the downside over here, there was very strong volume on this day, and it did try to have some continuation, yet the daily volume failed to reach this. So that tells me we're range bound. We failed to hold above this key level right here. And what happens intraday is you'll see we broke that key level right when the market opened, and then we rejected and sold off. So once we broke that level, a lot of institutional traders may have been tricked into thinking we're breaking higher. I need to long this. We're going to go to all-time highs. Meanwhile, all-time highs weren't till all the way up here, and they ended up trying to long a position that ended up reversing on them. So it's very important to be aware of the higher time frame as well as volume. Now let's check. Now, when I am looking at the minutes and the hourly time frame on a stock, I like to turn off the extended trading hours only for when it isn't earnings, because extended trading hours shows us overnight, and there are no traders overnight trading Costco or any other stocks. There's no true volume overnight as well. Therefore, I'm only interested in price action during the New York session. So something I see here on the 15-minute time frame is we're creating lower highs and lower lows. So unlike the daily and the weekly where we're creating higher highs and higher lows, the lower time frame, the 15-minute, the 30-minute, I'm sure let's check the hourly, even the hourly, if you're only looking back to February 13th, which is, let's see, we could use shift and click and we could drag out our ruler tool. So about 21 days. So for the past 21 days, Costco has been in a range and in a bit more of a downtrend. But if we look at the bigger picture, we see that there is no downtrend on Costco. It's simply a pullback. So I wouldn't be too worried on maybe exiting due to these earnings. I know we have this gap down so far, but I would really wait to see how the market opens and how the volume reflects. So if we get strong volume, and we could even check that again on the 15-minute time frame here. So we see that this was strong volume right here. This is 3:45 p.m. So this is in the afternoon, right before market closed. We had very strong volume. Costco went from 1,035 all the way to 1,048, almost a 1.25% move in a matter of 15 minutes. Now, if you were swinging Costco at that point, you had some type of calls, this strong volume was met with follow through that day. Now, I wouldn't be using this as a level to go long. I would be using this as a level as a target. Whenever we see pivots or swings, we want to see those more as targets than areas for a breakout, because a lot of times those breakouts end up just being fake outs. And those fake outs are the liquidity that is required to truly move the market. So instead of trying to take every break you see, be patient and trade your zones. Now, if we did want to mark up some supply and demand on Costco, I don't think it's going to be as smooth as it would something like the S&P 500 or the NASDAQ, because even though, yes, volume is strong and there are a lot of people investing into Costco, it's not as strong as something like the S&P 500 or the NASDAQ. These are major indexes. So supply and demand won't work too well, but support and resistance always works pretty well as long as you're running with the right confirmations. We don't want to be plotting out price levels and going, if it breaks here, I'll go long. If it breaks here, I'll go short. We want to plot our levels and use those levels to find our ranges. Once we find our ranges, that's when we're able to confidently take trades off of those range levels, because when we start breaking higher here, and we could even use our replay system, and let's bring it to the 15-minute too, we see that we were near this was an all-time high at this point, Now, people might be trying to take this all-time high breakout, but what happens when we try to break it? We ended up reversing. Let me make sure the replay system is on and running. There we go. So every time we tried to break it at that point, what happened? We reversed. So this might have even been a good spot to look for selling pressure. We see right at this breakout candle right up here, we have strong volume. Is it significant volume? It is compared to the recent candles, but it's not significant compared to the higher volume candles like this one right here or this one over here. It was significant in the sense that it was more than, let's see, we get our volume on here. It was more than our recent candles by almost double, but it still barely even hit that 50% of this volume shelf right here. So very important. And speaking of volume shelves, it's important to understand the volume profile. Guys, earnings call is in a few minutes, so make sure you guys stick around for that and make sure that we are listening for those few things that we mentioned before. We want to make sure that we're listening for how their memberships are moving. Are they retaining members? Are they increasing in members, especially after their fee increase? And don't forget, they are increasing fees in September again. Now, consumer shift to at-home dining could also be a plus when it comes to Costco in their food department. Inflation also impacting on margins. Now, this could impact all sorts of margins. We even have gold. Costco is a huge investor in gold, and it could even impact that. Gold was also in a bit of a bull trend up until recently. And the e-commerce and warehouse expansion. But what's really important in this coming earnings call is going to be their membership retention and their inflation impact. Is Costco really impacted by inflation? Are they bringing their prices up astronomically like eggs? Or are they sort of keeping prices the same? As we all know, Costco is the wholesaler, and that's sort of our go-to when it comes to buying in bulk at a good price. So guys, earnings call is in just a minute. Make sure you guys stick around for that, and I will see you guys afterwards. Let me know if you think you're bullish or bearish on Costco, and I'll see you guys soon.
Ladies and gentlemen, thank you for standing by. My name is Abby, and I will be your conference operator today. At this time, I would like to welcome everyone to the Costco Wholesale Corporation Fiscal Second Quarter 2025 Earnings Conference Call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer section. If you would like to ask a question during that time, simply press the star key followed by the number 1 on your telephone keypad. If you would like to withdraw your question, press star 1 a second time. Thank you. And I would now like to turn the conference over to Gary Millerchip, Chief Financial Officer. You may begin.
Good afternoon, everyone, and thank you for joining Costco's second quarter 2025 earnings call. In addition to covering our second quarter financial results today, we will also review our February sales results. I'd like to start by reminding you that these discussions will include forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. These statements involve risks and uncertainties that may cause actual events, results, and/or performance to differ materially from those indicated by such statements. The risks and uncertainties include, but are not limited to, those outlined in today's call, as well as other risks identified from time to time in the company's public filed with the SEC. Forward-looking statements speak only as of the date they are made, and the company does not undertake to update these statements except as required by law. Comparable sales and comparable sales excluding impacts from changes in gasoline prices and foreign exchange are intended as supplemental information and are not a substitute for net sales presented in accordance with GAAP. Before we dive into the numbers, I'm delighted to say that Ron Bakris is
and 4 additional U.S. openings next week, including our Sharon, Massachusetts opening on March 12th, which will be our 620th U.S. warehouse and the 900th Costco location worldwide. We're projecting 28 new openings during fiscal year 25, of which 3 will be relocations for 25 net new buildings. In addition to adding warehouses to serve our members, we also extended our gas station hours in North America during the quarter to make filling up at Costco more convenient for our members. Generally, our stations are now staying open an hour later than they did previously, with some opening earlier as well. Our updated employee agreement took effect this week in the U.S. and Canada. This agreement reflects our continued commitment to provide industry-leading pay and benefits for our employees. Highlights from the new agreement include an immediate $1 hour top-of-scale increase, followed by an additional $1 top-of-scale increase on March of 2026, and again in March of 2027. The top-of-scale wage for U.S. service clerks is now $31.90 an hour. Additionally, on March 3rd, our bottom-of-the-scale wage increased by 50 cents an hour, taking our minimum wage to $20 an hour. The average wage for the U.S. and Canada employees is now a little more than $31 an hour, including hourly employee bonuses, with the majority of our employees at the top scale based on tenure. Paid vacations for new employees is now offered during the first year of employment, and a 6-week of vacation is available to U.S. employees after 30 years of service. Our operations and merchandising teams did a fantastic job in the quarter, delivering strong operating results despite the uncertain macro environment. In particular, our Canada and other international business had an outstanding quarter, delivering record results on a constant currency basis, although reported results outside the U.S. were negatively impacted by foreign exchange fluctuations year over year. As we look ahead to the remainder of this fiscal year, headwinds from foreign exchange look likely to continue. Given events over the last week, it is difficult to predict the impact of tariffs, but our team remains agile, and our goal will be to minimize the impact of related cost increases to our members. About a third of our sales in the U.S. are imported from other countries, and less than half of those are items coming from China, Mexico, and Canada. In uncertain times, our members have historically placed even greater importance on the value of high-quality items at great prices, and our teams will continue to rise to this challenge by leveraging our global buying power, strong supplier relationships, and innovation. With that said, I'll turn it back over to Gary to discuss the results of the quarter and February sales. I'll jump back on during Q&A to field some questions.
Thanks, Ron. In today's press release, we reported operating results for the second quarter of fiscal 2025, the 12 weeks ended February 16th. We have once again published a slide deck on our investor site under Events and Presentations with supplemental information to support today's press release. You might find it helpful to have this presentation in front of you as I walk through our results. Net income for the second quarter came in at $1.788 billion, or $4.02 per diluted share, up from $1.743 billion, or $3.92 per diluted share in the second quarter last year. Last year's results included a tax benefit of $94 million, or 21 cents per diluted share, related to the tax deductibility of the special dividend paid to 401k participants. Excluding this discrete tax item, net income and earnings per diluted share both grew 8.4%. A couple of additional data points that may be helpful relative to our reported net income. Operating income in the quarter increased 12.3% compared to last year. This was partially offset by a $70 million year-over-year headwind in interest and other, and I'll share more detail on these items a little later. And foreign exchange rate movements negatively impacted the translation of international net income to US dollars by $57 million, or 13 cents per diluted share. Net sales for the second quarter were $62.53 billion, an increase of 9.1% from $57.33 billion in the second quarter last year. U.S. comparable sales were up 8.3%, or 8.6% excluding gas deflation. Canada comp sales were up 4.6%, or 10.5% adjusted for gas deflation and FX. Other international comp sales were up 1.7%, or 10.3% adjusted. And this all led to total company comp sales of 6.8%, or 9.1% adjusted for gas deflation and FX. Finally, e-commerce comp sales were up 20.9%, or 22.2% adjusted for FX. In terms of Q2 comp sales metrics, foreign currencies relative to the US dollar negatively impacted sales by approximately 2.1%, while gas price deflation negatively impacted sales by approximately 0.1%. Traffic or shopping frequency increased 5.7% worldwide and 5.6% in the US. Our average transaction or ticket was up 1% worldwide and up 2.6% in the US. This includes the headwinds from gas deflation and FX. Adjusted for those items, ticket would have been up 3.2% worldwide and up 2.8% in the US. Moving down the income statement to membership fee income. We reported membership fee income of $1.193 billion, an increase of $82 million or 7.4% year over year. Membership fee income growth was 9.4% excluding FX. The recent membership fee increase contributed approximately 3% of fee income in the quarter. Due to the effects of deferred accounting, the majority of the benefit from the membership fee increase will come over the next 4 fiscal quarters, with the largest impact in Q4 fiscal year 2025 and Q1 fiscal year 2026. In terms of renewal rates, at Q2 end, our US and Canada renewal rate was 93%. The worldwide rate came in at 90.5%. As cohorts of new members move in and out of this calculation, there could be 1 or 2 tenths of volatility in the reported number quarter to quarter. The biggest impacts come from digital promotions and Asia warehouse openings, both of which generate outsized membership signups, but also have low renewal rates. We ended Q2 with 78.4 million paid household members, up 6.8% versus last year, and 140.6 million cardholders, up 6.6% year over year. At Q2 end, we had 36.9 million paid executive memberships, up 9.1% versus last year. Executive members now represent 47.1% of paid members and 73.8% of worldwide sales. Turning to gross margin, our reported rate in the second quarter was higher year over year by 5 basis points, coming in at 10.85% compared to 10.8% last year, and up 4 basis points excluding gas deflation. To simplify the gross margin matrix provided in our slide deck, starting this quarter, we have incorporated 2% reward as part of the business area which generated the reward. This is split between core and ancillary and other businesses. Core was higher by 5 basis points and higher by 4 basis points without gas deflation. In terms of core margins on their own sales, our core-on-core margins were lower by 8 basis points. This decline was due to investments in supply chain to support higher inventory and some mix changes in our non-food categories. Ancillary and other businesses' gross margin was higher by 1 basis point and flat without gas deflation. E-commerce again showed considerable strength year over year, but this was offset by lower gas profitability. LIFO was lower by 1 basis point and flat without gas deflation. We had a $12 million LIFO credit in Q2 this year compared to a $14 million credit in Q2 last year. Moving on to SG&A. Our reported SG&A rate in the second quarter was lower or better year over year by 8 basis points, coming in at 9.06% compared to last year's 9.14%. SG&A was lower or better by 9 basis points adjusted for gas deflation. The operations component of SG&A was lower or better by 7 basis points and 8 basis points without gas deflation. Higher labor productivity and great cost discipline by our operators drove this improvement. Central and stock compensation were flat both with and without gas deflation, and pre-opening was lower or better by 1 basis point both with and without gas deflation, driven by fewer new warehouse openings in the quarter this year. As Ron mentioned earlier, our new employee agreement went into effect earlier this week. While there was no impact in Q2, we estimate that this will create a headwind to SG&A of 13 basis points from March the 3rd. However, we will also lap a smaller increase from the same point in the prior year, so the net year-over-year basis point headwind from this wage investment is expected to be mid-single digits. Below the operating income line, interest expense was $36 million versus $41 million last year, and interest income was $109 million versus $147 million last year. As indicated on last quarter's call, interest income faced headwinds due to lower cash balances subsequent to our $6.7 billion special dividend in January 2024 and lower interest rates. While we expect interest rates will continue to be a year-over-year headwind for the remainder of the fiscal year, we have now lapsed the lower year-over-year cash balances following the special dividend. FX and other was a $33 million gain in Q2 this year versus a $69 million gain last year. In terms of income taxes, our tax rate in Q2 was 26.2% compared to 22.1% in Q2 last year. Recall last year's rate benefited from a $94 million discrete item related to the tax deductibility of the special dividend paid to 401k participants. Adjusted for this benefit, the tax rate for fiscal year 2024 Q2 would have been 26.3%. Turning now to some key items of note in the quarter. Capital expenditure in Q2 was approximately $1.14 billion, and we estimate CapEx for the full year will be approximately $5 billion. Taking a deeper look into core merchandising sales, our non-foods category led the way this quarter with comparable sales in the mid-teens. Our buyers continue to bring in new and exciting items at great values. This included big-ticket consumer electronics products such as 98-inch and 100-inch TVs, Stern pinball machines, and gaming computers, all of which performed very well during the holiday season. For the quarter overall, gold and jewelry, gift cards, toys, housewares, appliances, sporting goods, home furnishings, and small electrics were all up double digits. Fresh in Q2 was up high single digits. This was led by double-digit growth in meat, where we continue to see a shift toward lower-cost proteins such as ground beef and poultry. Bakery and produce also performed well this quarter. Food and sundries had low to mid-single-digit comps, with cooler and international foods showing the strongest results. We continue to look for ways to increase the value for our members, both with national brand items and our private label offerings. Our goal is always to be the first to lower prices where we see opportunities to do so, and the last to increase prices in the face of rising costs. A few examples of lower prices this quarter include KS refined olive oil single 3 liter from $29.99 to $27.99, KS organic peanut butter from $11.49 to $9.99, and KS tortilla strips from $5.69 to $4.99. Another way we have been able to lower prices is by continuing to expand the local sourcing of our bulky private label items across the globe. In Q2, we introduced a KS purified water SKU for the China market that is produced in country. By moving production into the region, we were able to bring members savings of greater than 20% versus the prior branded water offering. Our merchants also continue to drive innovation with Kirkland Signature. Most notably this quarter, we worked with a new supplier to rework our Kirkland Signature diapers. Improvements versus the prior offering include a longer and thicker absorbent layer, softer outer cover, and 2 times more stretch in the waistband. As well as improving the quality of this item, we were able to increase the value by 11%. Other new KS offerings this quarter include KS French fries, KS vodka and soda, and new KS lager. Kirkland Signature continues to grow at a faster pace than our business as a whole. Within ancillary businesses, pharmacy and food court departments led the way. In the food court, we have introduced a new strawberry banana smoothie and are excited to announce the fan favorite turkey provolone sandwich is making a return in Q3. Gas comps were negative low single digits during the quarter, driven by the average price per gallon being down slightly. Now a few comments on inflation. While there was a fair bit of variability across departments, overall inflation in the quarter was low single digits. Fresh was the most inflationary of our categories, driven by meat and bakery. Food and sundries inflation remained relatively low, as inflation in eggs, cocoa, coffee, cheese, and corn were partially offset by deflation in commodities such as sugar, butter, and flour. The supply chain continues to be relatively stable, albeit shipping delivery dates are still less predictable than they were pre-COVID. In non-foods, our buying teams have been proactive in ordering higher levels of inventory over the past year, which has helped support our strong sales momentum, and overall, we are pleased with sell-through rates. Turning to digital and e-commerce, we continue to make progress with our technology roadmap. The new warehouse tool in our app, which allows members to view local warehouse item availability and prices, had over 43 million visits. On personalization, for the first time in Q2, we sent out multiple versions of our digital MVM, differentiating the message for members based on their previous shopping behavior. We still have a lot of work to do in this area and are excited about the potential to improve the member experience through more relevant targeted messages and experiences. While strength in bullion was a meaningful tailwind to e-commerce sales, home furnishings, small electrics, hardware, and sporting goods were a few of the other departments that grew double digits year over year. Costco Logistics had a record holiday season with over 500,000 deliveries as we continue to grow share in big and bulky items. And Costco Next, our curated marketplace, also had record holiday sales. We are now approaching 100 vendor sites and significantly grew average order value in the quarter. Shifting gears to alternative revenue streams, we made some improvements to our co-brand credit card this quarter. The card is a great way for members to increase the everyday value they receive when shopping at Costco, offering attractive cashback rates with no annual fee. Executive members who use the card can double their cashback on the majority of purchases in warehouse and at Costco.com from 2% to 4%. And last quarter, we increased the reward on gas purchases at Costco locations to 5%. On retail media, following our first off-site retail media campaign in Q1, we have entered into a number of additional similar campaigns with roughly 10 different partners live currently and many more in the pipeline. Turning now to our February sales results for the 4 weeks ended this past Sunday, March the 2nd, compared to the same 4 retail calendar weeks last year. Net sales for the month of February came in at $19.81 billion, an increase of 8.8% from $18.21 billion last year. Comparable sales for the month were as follows. U.S. comparable sales were up 8.6% both with and without gas deflation. Canada comp sales were up 3.2% or 8.7% adjusted for gas deflation and FX. Other international comp sales were down 0.6% or up 6.5% adjusted. This resulted in total company comp sales of 6.5% or 8.3% adjusted for gas deflation and FX. Finally, e-commerce comp sales were up 19% or 20.2% adjusted for FX. Our comp traffic or frequency for February was up 5% worldwide and 5.8% in the US. Foreign currencies year over year relative to the US dollar negatively impacted total and comparable sales as follows. Canada by approximately 6%, other international by approximately 7%, and total company by approximately 1.8%. Gasoline prices were flat year over year in the month. Worldwide, the average transaction for February was up 1.4%, including the negative impact from foreign exchange. In terms of regional highlights, U.S. regions with the strongest comparable sales were the Midwest, the Northeast, and Los Angeles. Other international in local currencies, we saw the strongest results in Mexico, Taiwan, and Korea. Moving to merchandise highlights, the following comparable sales results by category for the month exclude the negative impact of foreign exchange. Food and sundries were positive mid-single digits. Cooler, frozen foods, and sundries were the strongest departments. Fresh foods were up high single digits. Better performing departments included meat and produce. Non-foods were up positive low teens. Better performing departments included jewelry, gift cards, and housewares. Ancillary business sales were up low single digits. Pharmacy and optical were the top performers, and gas was down low single digits on lower volumes. And finally, in terms of upcoming releases, we will announce our March sales results for the 5 weeks ended Sunday, April the 6th, on Wednesday, April the 9th, after market close. That concludes our prepared remarks, and we'll now open the line up for questions.
Thank you. And we will now begin the question and answer session. If you have dialed in and would like to ask a question, please press star 1 on your telephone keypad to raise your hand and join the queue. If you would like to withdraw your question, press star 1 a second time. If you are called upon to ask your question and are listening via speakerphone on your device, please pick up your handset and ensure that your phone is not on mute when asking your question. To be able to take as many of your questions as possible, we ask that you please limit yourself to one question. Again, it is star 1 if you would like to join the queue. And your first question comes from the line of Simon Gutman with Morgan Stanley. Your line is open.
Hey, Ron. Hey, Gary. Simeon Gutman. I will ask one question. I want to talk about sales impact and the consumer broadly. Curious if consumers' willingness to purchase either discretionary or non-discretionary, as egg prices are booming, is the consumer cutting back at all? And then it looks like your results don't show an impact, especially in Canada, both in the quarter and in February. But curious if there's any slowing in any places from, tariff backlash, et cetera. Thank you.
Yeah, thanks, Simeon. To take the first part of your question, and the state of the consumer, I guess, more broadly, I think you're right in the way you described it. We're not really seeing any change in what we've seen around our members over the last really few quarters. We believe that the member is probably as much focused now on quality, value, and newness as they have been for quite some time. But they are still showing that willingness to spend, but they're being very choiceful where they're spending their dollars. And we think that's likely to continue and maybe even become more choiceful as the impact of some return of inflation and the potential impact of tariffs could flow through as well. I'd say we're also seeing a continued sign of what I mentioned last quarter, where there's some indication that members are spending a little bit more on food at home versus food away from home overall. So they're kind of, I guess, the macro themes that we see. When we talk about individual categories, I would say on non-foods, again, I think you characterized it well for us. Our merchants have done a great job of really focusing on those 3 key themes that we hear from our members around bringing in great items at great quality and great value. And while there's examples of that with newness around things like gold and some of the large electronic and gaming items I mentioned, we're really seeing it being fairly broad-based across all the categories that I listed on the call earlier. So generally, we're continuing to see strong trends overall in non-foods. There are a couple of categories generally that have been flatter, I would say, over recent quarters, consumer electronics and apparel. We believe we're performing relatively well on those compared to the industry, but they are lower trends on those items than there would be in some of the other categories that I mentioned earlier. And we're seeing, as I mentioned in some of the prepared remarks, we continue to see great trends on fresh products overall. And it's really a bit of bifurcation there. We're still seeing really good growth on the more premium meat items, but we're seeing even faster unit growth, I would say, on some of the lower cost cut items like ground beef and poultry and pork. So overall, I think the trends that we've seen, we're not really calling out anything significantly different, but of course we're watching very closely and making sure we're reacting to what we see from our members. On Canada in particular, as you mentioned, really the results that we reported in February are very much in line with the results that we've seen year to date. They actually had the strongest overall comp sales when you adjust for FX and gas out of the 3 reported segments that we talk about with international, US and Canada. but they had a phenomenal Q2, so they did come down a little bit from the trend that we saw in Q2, but still very strong results overall.
Thanks, guys. Good luck.
Thank you.
And your next question comes from the line of Michael Lasser with UBS. Your line is open.
Good evening. Thank you so much for taking my question. With core and core margin being down modestly this quarter, should we take that as a sign that the recent string of margin expansion that Costco's been able to achieve is coming to a conclusion or at least a pause, especially in light of what seems to like going to be a much more inflationary environment and a difficult dynamic with having to manage through the tariffs? Thank you very much.
Yeah, thanks, Michael. Thanks for the question. No, I wouldn't really read too much into the individual results in the quarter on the core margin. Overall, we were pleased with the fact that the gross margin rate was up 4 basis points, so a slight improvement while we were still investing in more value for the member. When we look at the breakdown of that, core on core, it was down, as you mentioned, 8 basis points. To give you a bit more color on that, food and sundry was actually up slightly, fresh was up slightly, non-food was down slightly. So there was a sort of a mix change in there somewhat that impacted the number as well. You may have heard me mention on the prepared remarks, but one of the things that was an increased cost during the quarter was higher supply chain costs as we had been continuing to buy more inventory, which we think will be helpful as you think about some of the unpredictability that we've seen in supply chain timing and also with the potential risk around tariffs. And really, when we looked at the overall results for the quarter and saw that the core margin overall was going to be up slightly, we have that ability to be able to invest and ensure that we're continuing to take care of the members. So we were quite deliberate on that this quarter. But again, I wouldn't read too much into the individual puts and takes. We feel good about the overall margin and our ability to keep investing in the member while at the same time, continuing to deliver the results that we delivered.
Thank you very much and good luck.
Thanks.
And your next question comes from the line of Christopher Horvers with JP Morgan. Your line is open.
Thanks. Good evening. So one quick follow-up and then an additional question. Other retailers are talking about weather having a negative impact on some of their more weather-sensitive businesses. So I guess turning the question upside down, do you think about the 8+% core comp that you saw in the month of February? Did you see any weather headwinds on your discretionary businesses, or was it just simply offset on the egg side? And then on the tariffs, historically, foods, for things that come from like Mexico that are fresh foods, historically, that stuff gets passed through directly to the consumer. How do you think about, Costco's stance on that? There's opportunities maybe with eggs where you're vertically integrated and you can absorb some of the costs. But as you think about stuff like fresh food that's more commodity-based, would you just pass those price increases along? Thank you.
This is Ron. As far as the weather, we experienced the same weather everybody else did the last month. And, we tend to capture a lot of that back if that's not an extended event and if it's not tied to a holiday. So, we saw some hits here and there, but we recovered most of that. And there probably was a little bit of the edge on sales taken off due to some extreme weather in the Northeast and the Midwest. So we feel pretty good about, how we handled through those storms. As far as the tariffs go on the grocery items, our buyers deal with those like they would any other cost increase. And, they're sometimes the margins are much tighter in those categories, but they're prepared to work closely with the suppliers and see how efficient we can bring goods to market. And is there anything we can mitigate in those categories? So the tariffs are very fluid right now, so it's hard to really, give any predictions on what we can do. But we are prepared. Our people are very well equipped to lower prices and defer any cost increase that come our way. So we're going to do all we can should that happen.
Great. Thanks very much.
You're welcome.
And your next question comes from the line of Scott Ciccarelli with Truist Securities. Your line is open.
Hey, guys. Scott Ciccarelli. With your treasure hunt structure, you guys have a lot of merchandising flexibility. So I guess if we get tariffs rolled into China, Mexico, Canada, would the strategy be more focused on look, it is what it is. Costco will still have the best value for those products relative to others? Or would there be a more aggressive effort to find goods from less tariff impacted countries? Thanks.
It would be a little bit of both. I mean, you're exactly right. With our flexibility of the treasure hunt, there's not many items that we can't find something to replace or something else to bring in that category. But it's going to be a little bit of both of those strategies that we can. As we say, when it rains on everyone, such as a tariff, that we're all equal there. And I feel like our people are very well equipped to deal with anything coming our way with our reduced SKU model. And we have great partnerships with our suppliers, and those items are very important to them as well. So I feel like we are well equipped to deal with whatever is coming our direction. And not knowing what that's going to be, I can't really tell you what the outcome will be, but our people are nimble and they're ready to go at it if they need to.
Thank you.
And your next question comes from the line of Zihan Ma with Bernstein. Your line is open.
Hi, thank you for taking my question. So a bit of a follow-up on the international side. First of all, a short-term question in terms of the February sales result. Is there any timing shift between January and February that led to this sequential slowdown in the other international segment? And longer term, can you just provide an update for us to understand how do you think about the long-term international growth runway from here? Thank you.
Sure, yes. On the first part of the question, there is some impact from, particularly on the Asian markets, the Chinese New Year. We generally, because it didn't roll up to be a meaningful enough number at our total company level, we didn't call it out in our results. We didn't call it out in the January number specifically either. But yes, I would say you have to kind of look at the 2 months and combine the two really to understand the trend because of the impact that we would see from the Chinese New Year impacting particularly Korea and Taiwan and China. And then in terms of the long-term prospects for our international business, Ron mentioned it in the prepared remarks. We had a tremendous second quarter. We were thrilled with the progress that we saw across those international markets overall. And as we think about new warehouses and the plan there, as you may recall, we talked about 25 to 30 new warehouses a year. And as we look at our long-term plan, we would think just over half of those would likely be in the US, but just under half would be in our international markets, including Canada, Mexico, Asia, and Europe. And we look at all four of those as strong markets for us and opportunities to continue to expand our presence because we wouldn't see any of those as being fully penetrated today. And we're fortunate in that our international markets have similar or in some cases better profitability as a rate to sales than we have in our US market as well. So we still see plenty of opportunity and they remain an important part of our growth strategy.
Great, thank you.
And your next question comes from the line of Oliver Chen with TD Cowen. Your line is open.
Hi, thanks, Ron and Gary. We had a question about general merchandise and electronics. Would love just thoughts on what you're seeing with respect to those categories and the health of the consumer. We've also thought that you've done a great job with UPTs and innovating with international products. It'd be great to hear prospects there. And then a follow-up is on the more targeted and strategic multi-vendor mailer as well as digital promotions and deals. What's happening there? It seems like there's some nice traction and is it driving traffic or how are you approaching the next inning of that? Thank you very much.
Sure, thanks, Oliver. I'll just quickly rattle through. I think there were sort of three different components there. So on consumer electronics, generally speaking, we believe, and from what we see, we're growing market share, but that area would still be relatively slow. So we're flat to slight growth there, whereas the market overall, though, still seems to be pretty sluggish. And I think we're still looking for that next wave of new innovation to really spark extra growth in that category. We did see some really nice sales around the holidays on the larger TV screens, the 98-inch and 100-inch TV screens. I think that created some new excitement and visually was very compelling in the warehouses, and our operators did a great job in merchandising those, and we saw some nice lift at that time of the year. But overall, relatively flat as a category, especially compared to many of the other non-food categories where we see double-digit growth currently. On the international products, I think was the second comment you made. Yeah, we're really excited about that opportunity. We continue to see at our monthly budget meetings when we have all of our operators come in, they're sharing examples of products that are resonating in each of the markets that we operate. And very quickly, because of the ability to share those ideas across the teams, we're finding ways to bring those and bring our global buying to bear and finding even better ways to bring them to our markets, but also a better value for our members. And we've seen some great growth in those opportunities, and we think that'll be an important part of our continued growth in the future as well. Ron, anything you want to add there as well?
Yeah, no, and I think Gary is 100% right. And then on the multi-vendor mail and the promotions, you know, that it really is excitement in that product mix. And it's a good balance of everyday low prices that our buyers work towards on ensuring the key commodities are at an everyday price that our members can count on, but also bringing in some newness and excitement and partnering with our suppliers when they want to drive some sales, and we can deliver that through the multi-vendor mailer. So I think the key to the success there, it is driving traffic. It continues to be a win for our members. And I think the newness and keeping it fresh has been the key to that success.
Thank you. Best regards.
Thank you.
Thanks.
And your next question comes from the line of John Heinbockel with Guggenheim Securities. Your line is open.
Hey, Ron, I had a couple of holistic questions with regard to KS. You know, when you think about new item introductions, KS versus national brands, how does that kind of compare in most years? You know, when you think about categories where KS has a lower penetration, right, which is a lot of non-foods, where can you kind of make breakthroughs there, right, and introduce KS items that don't currently exist? And then would you think a very high percentage of the KS introductions, you know, end up being permanent fixtures in the assortment?
Okay. Yeah, you know, the greatest opportunity we have would be in non-foods. And it was something, as a category that we always felt brand loyalty was extremely strong, which it is. But, you know, the motor oil was a great example of, it is now our top-selling motor oil in all of our warehouses across here as a Kirkland Signature, where that was a very brand-related item before. Golf balls was another example of when we entered into a extremely brand-loyal category that we were able to break through. So we see great success there. You know, our buyers continue to look at where are those opportunities that we can improve quality from the brand or meet the quality of the brand and bring a substantial value to it. So we're not in a race to develop hundreds of Kirkland items. We look at it more of a strategic item-by-item basis, that when there's an item that with an opportunity, then that's when they'll go after that. The recent the sandwich bags and storage bags that we did in our sundries department are a tremendous value, supreme quality, and really doing very, very well. And yes, you're right, we do have a very high success rate of Kirkland items. I mean, but there are failures out there. There are things that we always say, Claudine and myself, our head merchant, we can't fall in love with our own stuff. And so we hold Kirkland Signature to the same standards we would as any branded item. If the sales are not performing, our members are not resonating with that item, it is as quick to go out as any branded item would be as well. So there's no annuities to a Kirkland item. It has to meet the same standards. But I'm very proud of the buyers that they do have a high success rate. They do their due diligence on those items, and they really deliver great value to the member when we launch a Kirkland item.
Thank you.
You're welcome.
And your next question comes from the line of Rupesh Parikh with Oppenheimer. Your line is open.
Good afternoon. Thanks for taking my question. So I guess, Gary, just going back to that 13 basis point headwind on the wage front, I think starting in March, is that headwind larger given it's the first year of the agreement, given some of the other changes? And then just related to that, given that it is a significant headwind, do you guys see any new productivity opportunities to help offset some of the increased wage pressures? Thank you.
Yeah, thanks, Rupesh. Just to clarify, to answer your question, as you may recall, we had a number of wage investments that we made back in March last year, or a wage investment, I should say, we made in March last year. And then we had another wage investment in July where we introduced a $1 increase at the bottom of the scale and the top of the scale, and a 50-cent increase in the intervening points between those two. And then we just announced the wage increases that we've implemented this month with our new employee agreement. So overall, what you're seeing is that the investment from this time last year will drop off. Well, we won't drop off, but we'll have cycled it. So we've made that investment now, and that's embedded in the numbers that we're operating with. So the headwind that we'll see in the current quarter will be the investment from July and the investment that we've made in May. As you think about it quarter on quarter, it's about a mid-single-digit increase in the basis point of investment because we're essentially cycling last March's and replacing it with this new increase. So think of it as adding about a mid-single-digit basis point increase on our wage investment in the new quarter. And to answer you, and should also say there'll probably be a sort of one-time catch-up in Q3 as well. That'll be the accrual for vacation for the full year because we're implementing that now, but we have to go back to the start of the fiscal year with that change. So there'll be an adjustment in the quarter for that as well. Outside of that, to your point, we were very successful in the current quarter. Our operators in Q2 did a great job of continuing to drive productivity and continuing to improve efficiency so that we actually still were able to achieve SG&A leverage, as you heard me talk about earlier, of 9 basis points actually on the core. And so, our goal will be exactly the same, is to continue to find ways to be more efficient because we are committed to continue to invest in our employees. As part of our code of ethics is to make sure that we're delivering industry-leading wage and benefits for our employees. So that'll be a continued part of the strategy. But that also includes being more highly productive and finding ways to fund those through labor productivity and continuous improvement. That's certainly the expectation we set for ourselves.
Great. Thank you. I'll pass it on.
And your next question comes from the line of Greg Melich with Evercore ISI. Your line is open.
Hi, thanks. I had one clarification, then my question. The clarification was on inflation. I heard up low single digits. Is it fair to say that grocery was slightly above 1% and then maybe general merchandise was deflationary? And then I wanted to ask about alternative media.
Yeah, on the inflation side of things, so fresh was our highest of the three categories, and particularly in meat was the highest there. Food and sundries would have been very low single-digit inflation, but still inflationary. And I would say important to know, I guess, that the trend was a little bit of an increase during the quarter because if you recall, last quarter we shared that inflation was flat, so we did see some increase in inflation as the quarter progressed. And I'd say meat was the largest of those. Food and sundries would have been next, and non-foods has been deflationary relative to recently. That's sort of evening itself out now as we cycle some of the deflation from the supply chain about a year ago.
Got it. Thanks. And then on the alternative media, you talked about building that out. Could you help frame it a little bit, Gary, and the strategy behind it? I mean, some of your peers have shown 4 or 5% of digital revenues can be, the advertising business. How do you guys think about that?
Sure. I think overall, I know I've mentioned this previously as well in discussions, that we do have an alternative profit stream today where we generate significant value through a large co-branded credit card program, the travel business that we have, and we have a revenue, e-commerce ad revenue stream that comes from many of the suppliers that participate on our website today, and that's a few $100 million. So there are a number of areas today where we generate value in that space. Having said all of that, we do believe that the new sort of retail media theme, which is really going after the marketing dollars that the CPGs are spending, is a significant growth opportunity for us. We are, though, in the very early stages of that. We need to continue to build out the infrastructure and the capabilities. And I would say we're not only building those out to deliver on a retail media platform that we want to create for our CPG suppliers, but also to build out more of a sort of personalized capability for our own membership experience. So delivering more targeted and relevant messaging and sort of think of it as the right offer, the right communication through the right channel to the right member at the right time. And this is really the capability that we're building for ourselves today, and it will take some time to do that. So it's likely to be a multi-year roadmap as we build those capabilities, I would say. But we did at the same time launch this sort of offers media channel so that we can start to really test and learn and grow capability with our CPG suppliers. And there's been a lot of interest and appetite to really build that capability. And as we mentioned on the call, we now have 10 campaigns live, and we see a lot more in the pipeline. From our perspective, though, we've also mentioned this in the past, is that I wouldn't think of it as Costco really coming out and declaring a new revenue stream with a new margin profile. We'll think of it very much as being, how do we generate that fair share of that value so we can reinvest it in our members and continue to drive our overall loyalty member engagement and drive top-line sales. So a little bit of a different approach for us than you probably hear from some of our peers and others.
One more reason for a bigger executive rebate.
There you go. Exactly.
All right. Thanks, Gary. Good luck, guys.
Thanks.
Thank you.
And your next question comes from the line of Edward Kelly with Wells Fargo. Your line is open.
Yeah. Hi, good afternoon, guys.
Hi,
I
Ed.
wanted to ask you about throughput in the stores. Maybe you can talk just a little bit about, like where you are from a standpoint of initiatives to drive better throughput. I know you're scanning now when people are coming in, and I'm sure what you're doing with that data. But then when you think about, checkout and exit, and obviously it's a high-class problem, but it's very busy. And then, you did mention extending hours on the gas stations. Is that something that you maybe could take to the stores that would help with that problem? Thank you.
That is a very good question. The speed of the checkout is one of our primary focuses right now, and what uses of technology we have. Scanning at the front door was very, very helpful for our operations, really kept our people informed on what traffic looks like, and they can adjust opening up registers and closing registers, and we saw some great improvements in productivity from that as well. That was just a foray into the whole technology thing. So we see many things going with self-checkout, how we can improve that. And so that is indeed one of our biggest areas of focus for technology in our warehouses, is how we can get members through quickly and turn parking spaces and do those type of things is a big push for us. Yeah, the scanners were a very big win for us. I'm sorry?
Yeah, I'm sorry. Would you consider extending store hours? I know that's probably logistically, a lot harder than it sounds. Just curious your thoughts there.
That is something that is not off the table. We do look at that. I mean, our gas expansions, we have 60 U.S. gas stations going through they're at a different phase in expansions now. We did see some demand from the commuters, both at the early hours and the evening hours. So I think that's going to be a real benefit to those folks as well. But we will continue to look at the warehouse hours. No plans in place at this time, though.
Okay, thank you.
You're welcome.
And your next question comes from the line of Chuck Grom with Gordon Haskett. Your line is open.
Hey, thanks very much. I wanted to just go back to the digital MVM and was curious how vast that effort has been at this point in time. I guess maybe how many members received the digital MVM, and are you replacing the paper MVM? And then I guess the ultimate question is, what have you learned so far in terms of elasticity or response rate?
It allows us to do different things that you can imagine the print process is quite extended. So our merchants are 2 months out when they're putting together the mailed MVM, which is still very effective. I mean, it's still very effective when these arrive in people's homes. The digital MVM gives us quite a bit of nimbleness that up till the day before we put that out there, we can, if a vendor wants to jump in and wants to drive some sales, and it really gives us a lot of flexibility. So our buyers have taken some items out. They run the digital MVM for 10 days compared to the 28 or so that we had run the regular MVM. And you may be able to let other vendors now get into this type of a communication to people. And it really drives a lot of sales, but it has been incremental to the mailed MVM that we have out there. So we found it to be very effective. And it's, we're talking, 40 million people are getting this kind of a imprint in their email on what kind of activities. One of the biggest open rates we have in our email is what's going on in their warehouse nearby. And so when members get to see new items that are arriving and items that are on a special deal from the supplier, it's very effective for us in driving traffic.
And Chuck, maybe just to build on the part of your question that was tied to more of the targeted element of the communication. Think of it as our first sort of foray into how do we be a little bit more targeted by using our membership data to make the message more specific to how you shop with Costco as a member. So how frequently you're visiting us, what are the type of products that you're buying, and then kind of reprioritizing the way in which the individual items are messaged on the communication to reflect more that's relevant for you, and also the messaging that's really driving the communication to the member at the top of the email that's sending out the message as well. So it's really that first step for us into saying, rather than one size fits all, how can we start to adjust that without changing the way we go to market, but just making the communication part of that more relevant. And the early signs were encouraging around the level of engagement and the change in behavior that we saw as a result of that. So certainly more to come on that front.
And just a quick follow-up, Gary, I guess, when did you guys start that effort?
That was this last month.
The
Okay,
digital
great.
MV, the
Thanks very much.
digital mailer has been for years, but the more personalized was this month.
Yes.
Right. Okay, cool. Thank you.
And your next question comes from the line of Kelly Bania with BMO Capital Markets. Your line is open.
Hi, thanks for taking our questions, Ron and Gary. Wanted to just ask about membership fees. Obviously, you've had the increase in US and Canada that's flowing through, but any update on where you are at with other international countries, and if it's the right time for any changes there, and maybe just also an update on the other international countries' executive programs, if there's any plans for any additional rollouts there.
Yeah, thanks, Kelly. So on the membership fee, first of all, yes, we increased the membership fee in Australia in 2023, fiscal year 2023. Mexico actually increased last year as well. That was in September. And actually, we just announced in Japan and Korea a membership fee increase as well. So we don't have them all on the same cadence. They tend to be tied to their own individual plans and when the membership fee was introduced and when they've previously had changes. So it doesn't always follow the same cadence as the US, but we are changing membership fees in those countries or have already, and other countries will continue to look and review on their own sort of cadence. So continuation of the previous strategy there is very much the plan. And then on executive membership, typically we look at it from the basis of when we reach enough scale in an individual market. We have executive membership in a number of the Asian markets. We have executive membership in Australia and the UK as well, because again, they've reached a level of maturity and size. But the exciting part there, I'd say, is that if you look at Canada and the US that have the highest level of executive membership penetration, as you go down that maturity curve, Asia would be next, but would still have a meaningful opportunity to continue to grow executive membership more towards the US and Canada conversion rates, and Australia and the UK would be further behind Asia as well. So as they go through the maturity curve, it's one of those areas where we see opportunity to continue to increase executive membership penetration. And as we grow some of our newer markets and smaller markets into larger number of warehouses, we'll continue to evaluate the opportunity to introduce executive membership there as well.
And your next question comes from the line of Robbie Ohmes with Bank of America. Your line is open.
Oh, hey, Ron and Gary. Thanks for taking my question. I was wondering, excuse me, if you could talk a little bit about the average ticket trends in the US ex gas and give a little more color on mix versus number of items versus inflation impact. And if anything is changing there in terms of how you're getting to average ticket ex gas. And maybe related to that, I was just kind of curious if sugar and butter and flour are deflationary, why is bakery inflating?
Sure. Yeah, sure. I'll take the second one first. It's easy. It's really eggs that's causing the major pain there. It's kind of it's offsetting, unfortunately, just the percentage growth that we've seen in eggs has far outweighed the deflationary situation on those other items. In terms of sort of mix in the basket, I'd say we've been really pleased over the last 12 months, because if you'd looked at our results 12 months ago, we'd have seen consistency in the visit growth, which has continued to be the case. And that's been something that, has been a trend that for the last 2 or 3 years that we've been extremely pleased with and seen that continued frequency of increase in visits. But about a year ago, we would have been flat to negative on the overall sort of basket size. And as you look at the change that we've seen over the last 12 months, partly I think because of the improvements that we've seen in non-foods growth over that period of time, and as we've continued to deliver great assortment and great quality and great value for our members, we've really seen our merchants and operators do a really good job of turning the corner in that situation and growing the number of items in the basket and the overall basket size. Up until this quarter, as you know, inflation has been relatively flat for us, so any improvement that we were seeing at that point would have been largely driven by items in the basket versus the or upselling in terms of better or bigger products by the member versus inflation driving that growth. But obviously that could change this year depending on what we see with inflation and also with the potential introduction of some tariffs.
Got it. Thank you.
And your next question comes from the line of Joseph Feldman with Telsey Advisory Group. Your line is open.
Yeah, hi guys. Thanks for taking the question. Had two kind of quick ones for you. First, on gas volumes, I think I heard you guys say the volumes have been down, and we heard that from another company you know pretty well, Gary. And I was just wondering what is driving that. It was a little surprising to me to hear that the volumes were down. The other question was about stores. If you could just remind us, you know, the kind of new versus existing market balance of stores and also U.S. versus international for the year. Thanks.
Sure. Yeah. On the first part of the question, so the comment that we made about gallons being down was very specific to February. So if you look at our year-to-date results, we would be positive in gallons on gas. I would say that you know, there isn't a huge amount of growth, and I suspect the market generally may be flat to down, but we've been growing our market share as we look at the year-to-date. It's a little bit difficult to talk about one particular month because as Ron mentioned earlier, certainly weather can have an impact on those things. So we'd look at probably the trend over a slightly longer period of time and say generally gallons are up, but it's you know, it's low single-digit growth in gallons versus you know, compared to the growth that we see in other parts of the business today. On new stores.
Yeah, I've got that one. This year we'll open 15 locations in the U.S., 3 in Canada, and we'll have 7 in the other international countries that will open up. And that's pretty typical for a normal 25 warehouse year for us.
Got it. Thanks, guys. Good luck with this quarter.
Thank you.
Thanks.
And your final question comes from the line of Mike Baker with D.A. Davidson. Your line is open.
Okay, thanks. First, as a lifelong resident of Sharon, Massachusetts, I'll just say that the entire town is really excited for your 900th store. The buzz is high. My question also on gas. I'm just wondering, the extending the hours, has that led to incremental gallons? Are you seeing customers take advantage of that? And then a second question, just periodically we ask about your price gaps versus others. How do you see those right now, particularly with some inflation creeping back in? Thanks.
Thanks. Yes. On the first part of the question, yes, we've been pleased so far with the member reaction, and we are seeing an improvement in overall usage of the gas stations. So that's it's early days, of course, but so far we've been pleased by the member response. And then, so what's the second part of the question?
Price gaps versus competitors.
Oh yeah. So you know, really, this is something that we tend to look at it. We really tend to view ourselves as our own biggest competitor. You know, we have every period we have our budget meetings and we look at our prices, and our goal at every meeting is to find where can we find ways to lower costs and lower prices for our members. So I would say we feel really good about our price gaps. We generally, the price changes that we're making are proactive versus reactive to others. But if we do find any area in those meetings where we believe we need to adjust, typically the operators in those markets have adjusted those prices before we've even gotten to the meeting. So overall, we believe that the focus on delivering the best value and quality and pushing ourselves to always get better is what's important, and we think that certainly reflects in our overall value that we're offering today.
And we hope to see you next week in Sharon, Mike.
I will be there.
All right. Good.
I'll see you. I'll say hello.
All right.
Thanks, Mike.
And ladies and gentlemen, this concludes today's call, and we thank you for your participation. You may now disconnect.